Just whenever? Get started? All right. Thank you all so much for coming. My name is Seth Norris. It's not starting soon, it's starting now. I'm a CPA. I've been a CPA for 15 years. The last 5 years, I have been doing my accounting practice for myself. This is my family. My wife's in the back there being videographer for me. But you didn't come to learn about them or me even. But before we do get started, I want to tell you a story. Hey, Christina. Whenever I was growing up, music was a huge part of my life. I always wanted to be a musician. I took piano lessons since the age of 7. I started learning guitar to impress girls. Then I played trumpet in the marching band, not to impress girls. But I'd never thought of a way that I could get it to be something that I could earn money with, that I could make a living out of. I didn't think of it as anything like that. So high school, it started becoming a serious thought, like, could I do something with this music stuff and actually earn money with it? Spoiler alert, I have not done that. But getting towards the end of high school career, having to pick a major, at that point, some girl, not my wife, some other girl told me that she thought I would make a good attorney. We weren't dating yet, just to be clear. And she said, you also look really good in a suit. So at that point, all I ever want to do is be an attorney, right? So I'm hatching this plan on like, okay, how do I go to law school? How do I be a musician? How do I get my mom to pay for all this? So I tell my mom, hey, listen, I have an idea. And that's her over there on the right. I say, you don't have to actually go to any kind of major to go to law school. You can major in whatever you want. So I'm going to major in music and minor in like political science or something. Then I'll go to law school. And I said it like it was a good idea, like I thought she'd be excited. And she says, what if instead you major in something that you can earn a living in? Because she didn't think too much of my music, apparently. And then you can minor in music. That way, if you decide not to go to law school, then you can get a job. And I was like, I guess that makes sense. And you're holding the checkbook, so I'm going to do that plan. But what should I major in? Because I really don't even know what to major in. She says, you've always liked business. Why don't you major in accounting? I said, that's fine. In the back of my mind, I'm thinking, I'm going to be a musician anyway. I'm not going to be an accountant. So who cares what I major in? So here I am. I ended up falling in love with accounting. In college, it was funny because I would go to the College of Business in the morning because my business classes were in the morning because music classes aren't in the morning. And then I'd go to the music classes in the music room in the afternoon. In the College of Business, everyone's kind of dressed like this, at the very least, a polo and khakis. In the College of Business, in the College of Music, it was basically pajamas. Like it might be the nice sweatpants, but it wasn't any more than that. But it was so cool because like the musicians, they were all expressing themselves in their own way, whether it's through music or how they dressed or how they talked or anything. And I love that. And I loved having that kind of dichotomy between the business stuff and all the numbers and the debits and the credits, and then just the music and that side of the brain. And one of my favorite things from college, one of my favorite memories is at UL, upstairs in the music room, they have the practice rooms. And it's this short white hallway with doors on either side. And as you're walking through, you hear just sounds, trombones, French horns, pianos, vocals, and they're just practicing. And no one's listening to each other because they're individually practicing, but they just making all this noise that individually is beautiful. And so from that, I've taken that into my career, and if you can believe it or not, in taxes, when I look at a tax return and I see the stuff that y'all submit, and it's just messy and it's gross, and some of it's not even for the right year, and some of it has nothing to do with your tax return, and it's just like going through the music hall, and it's all these noise, and I love taking it and just organizing it into nice little pieces and making something beautiful with it, just like you would with an orchestra. So I'm able to kind of mold the music, the love for music and taxes and business into all that. So what I'm going to do today is in the last 5 years, I have really niched down into creative entrepreneurs, photographers, artists, authors, creators, you name it. I love those types of businesses. And I'm finding that y'all are underserved by the CPA community because large CPA firms, they like their big industries. They like the payroll. They like all the employees. They like the locations. I don't like all that. I like you working at home, trying to make a living, trying to quit your 9 to 5. So over the last 5 years, I've worked mainly with creative entrepreneurs, and I've come up with, where did it go, Jessica? There it is. I've come up with questions that I typically get asked whenever I have a first call with a creative entrepreneur. Usually the first question I get, or the first thing I ask an entrepreneur is, what questions do you have for me? And usually the response is, I don't know what questions I'm supposed to have. So if you're going to meet with your CPA, and if it's me or if it's anybody else, or you're meeting a new CPA, you can take a picture of this and bring that with you That's 5 questions that you can ask your CPA. I'll move out of the way in case if you want to, and I can bring it back up at the end if you don't have time. The QR code is just my website. I'm going to go through some of these today, but the main focus of this is going to be taxes. Sorry, I'm in everybody's way. Got it. And I can send this to you at the end if you want to give me your email address. I'm going to probably make this one of those stupid, like downloadable PDFs that you have to give me your email address to get. So this is your chance to get it without getting on my mailing list. All right. So we're going to cover these 4 main things. S Corps versus LLCs, basically choice of entity, how to deduct your vehicle expenses, how to deduct your home office expenses, and then how to prepare for taxes before the end of the year. Is this the most boring topic y'all have ever hosted? Taxes for creatives? It can't be one of the most exciting. So I appreciate y'all being here. Oh. Oops. So entity choice. Whenever you're making money from your art, whether you're selling your art, you're being commissioned for it, whatever, you have a business whether you like it or not. So you are a business owner and you can be taxed like a business owner. Choice of entity can be important. If you don't do anything, if you don't set up anything with the Secretary of State, if you don't file anything, you're a sole proprietor. So you are your business. There's no distinguishment between the two. The next level up that people typically go to is LLC. So an LLC is a legal designation. It's actually not a tax designation. If your business is an LLC and you file your tax return, or if your business is a sole proprietorship and you file your tax return, they're going to look identical. The only thing an LLC is going to do is it's going to provide some sort of liability protection of your personal assets from claims against the business. I'm not an attorney. I did not go to law school. I'm not going to get caught on camera giving legal advice. So that's all I'm going to say about LLCs and liability protection. But an LLC can help you sometimes open a business bank account. It can distinguish you from just your personal. If you're going to be giving out 1099s, you might want to have your LLC name and your EIN on there instead of your social security number. So it's not a bad move to make, but nothing for taxes. A step up from that is S Corp. A step up from S Corp is C Corp. A C Corp is like Coca-Cola, Walmart. We don't talk about C Corps. S Corps can save you money. So you can be an LLC and you can choose to be taxed as an S Corp, and it's a designation that you can make at any time. You don't have to choose it from the beginning. So how does an S Corp save you money? I have to explain a little bit about how the tax process works. Bear with me. So whether you're an LLC or an S Corp, all the money you make from your business is going to get dumped into the LLC or the S Corp. All the expenses that you have are going to come out. You're going to get to your net business income. That net business income is going to go over to your personal tax return, whether it's LLC or S Corp. It's all going to get added to your other personal income, your W-2 income, your interest income, dividend income, all of it gets added together. It's going to be subject to your personal tax rate. So the LLC nor the S Corp, neither of them will pay taxes. It all goes to your personal return. They're called flow-through or pass-through entities. So that income goes to your personal return. With an LLC, that income gets taxed at your personal tax rate. Let's pretend it's 20%. There is no 20% rate anymore, but it's an easy number to use for math. So it gets taxed at 20% along with all your other income. But the LLC income is also subject to an additional 15%. It's 15.3, but 15 is easier. 15% tax for self-employment tax. All right, self-employment tax is the government's way of saying, if you had a day job, like a W-2 job for this income, you would have had Social Security and Medicare taken out of your paycheck. So let's say you made $50,000, you didn't get $50,000, you got $50,000 minus the taxes taken out. Some of those taxes is Social Security and Medicare. It's about 7.5% of your income is going to go to that. Your employer is going to also go into their pocket and pull out another 7.5% to add to your 7.5%. And those are going to both go, that 15%, on your behalf to the government for Social Security and Medicare. But that LLC income that came to your personal return, that didn't have any Social Security and Medicare taxes paid on it. So the government says, you're playing both employer and employee for this role. You pay both of those. You pay the full 15%. So if you had, let's say, $50,000 from your W-2 day job, $25,000 from your creative business that got added to the $50,000, you've got $75,000 of total income. That total income is going to be subject to your regular personal tax rate, say 20%. But then that $25,000 is also going to be subject to that extra 15%. So that $25,000 is subject to both. In other words, about 35%, possibly 35% taxes, depending on your personal tax rate. It's a lot. The difference is with an S Corp, if the money came from the S Corp and went to your personal, everything else is exactly the same, except you don't pay that self-employment tax. You save 15% on whatever that number is. So the next question, if I had a sub-question in there about the choice of entity, that I normally get is, why wouldn't everybody be an S Corp then? Like, what's the catch? There has to be something. Otherwise, we would all just save 15% on our taxes. And there is a catch. So with an S Corp, basically the only benefit is that you don't pay self-employment tax. But you are required to pay yourself as an owner a reasonable salary for the work you do in the business. All right. First, the IRS does not define what reasonable salary is, so we have to come up with that together. But second, that reasonable salary has to run through payroll and has to be subject to payroll taxes, like that 15%. So you're going to take, let's say, that same $25,000 of net business income from your business. Let's say that's $25,000 before you've paid yourself. And let's say that we determine that your reasonable salary is $25,000. We're going to take $25,000 out of your business pocket. We're going to put that $25,000 into your personal pocket, but along the way, the government's taking 15% for payroll taxes. So now all you've done is you've traded payroll taxes, you've traded self-employment tax for payroll tax. You've gained nothing if you have to pay yourself the full amount of your business income. Does that make sense? A lot of numbers. All right. So on top of that, you may also be required to pay workers' comp and unemployment tax if you're an S Corp and you have payroll. On top of that, you're now going to have to file quarterly payroll tax returns and an annual payroll tax return and do other payroll related things. And so you're probably going to have to pay a payroll service provider for that. And you're going to have an additional S Corp tax return at the end of the year. So you're going to have to pay another tax prep fee for that. So extra taxes, extra costs, and in the compliance of it, it's a lot easier to operate an LLC. If you pay for something out of your personal pocket on behalf of your business, like you go to a business meal and it's a legitimate business meal and you pay for it out of your personal money, you just tell me and I'm going to throw that on your business LLC tax return, no problems. You do that with your S Corp though, we have to act as if the S Corp reimbursed you as an employee for business meals and make documentation. So it's not nearly as easy to pay for business expenses out of your personal account if you're an S Corp. You also have to keep better records, better documentation of things. So first thing you have to do, you have to determine, do I make enough money in my business to be able to absorb a reasonable salary and still have enough left over to be able to have enough tax savings to overcome those extra costs involved? If the answer is yes, the next question you have to ask is, do I want to do this? I have a client that makes way more than she needs to make for this to make sense numbers wise. She's told me, I'm not doing this. I know I'm not going to do it right. I'm going to have all my business and personal stuff mixed together. I'm never separating it. I'm not doing any bookkeeping. I don't want the risk of it. Not worth it. And that's fine. That's a reasonable stance to take. This is more than just numbers. You have to consider your behavior and what makes sense for you. You do if you're not paying yourself a reasonable salary. And I'm glad you asked that. That's low-hanging fruit for the IRS. If they see an S Corp tax return and you didn't pay yourself wages, or they see an S Corp tax return and you paid yourself $5,000 of wages, but you took distributions out of the company of $70,000 and you have no other income, it's so easy for them to come in and say, we're just going to reclassify those distributions as wages. That means all those payroll tax returns you filed or didn't file are now wrong, and you owe us back taxes and penalties and interest. And oh, by the way, let's look at those other years too that you did the same thing. And if they caught that 3 or 4 years later, let's look at every year since then and reclassify all that every year since then. We're also going to revoke your S election, and you're no longer an S Corp and you can't do it anymore. So there is an audit risk to it. It does not make sense to do this if you're not making, usually I'm starting to have the conversation with clients when they're consistently paying taxes on at least $30,000 of net business income. That's not the magic number. That's just the part where we start having the conversation for the next year in case if they end up getting over an amount that makes sense for them. Great question. Any other questions before we move on to the next fun topic? Vehicle expenses. This is my son Jude and his beloved Buc-ee's tray. So this is a question this is a screenshot of a text message I actually had where somebody was asking me if they should buy a big Mack truck before the end of the year or whatever. And I said, no, it's not going to make a difference for you. It's not going to impact your taxes the way that you do things. They said this, why do then everyone tells me that their CPA told them to go buy a vehicle before the end of the year? And it's because they have a bad CPA. He asked, I don't have that screenshot. He said, well, what if I like take a logo and put it on the vehicle? That way, everywhere I drive, I'm advertising. Can I deduct that? I said, you can 100% deduct the cost of that sticker that went into your vehicle. And that's about it, right? So we're going to talk about vehicle expenses and how to do this. There's two ways to do vehicle expenses. There's the actual expense method, and then there's the standard mileage rate. With the actual expense method, you're going to take the percentage that you use the vehicle in business, and the IRS is extremely specific about this. Business use equals miles. Period. Doesn't equal wrapping your car in some sort of advertisement. It doesn't equal lifestyle choice and you're trying to maintain an image. Nothing. It's miles, business miles. And business miles are very specifically defined as business location to business location, not daycare to business location, not business location to Walmart to home, not business location to home to business location to business location. We can maybe make home a business location if we can get you a home office deduction, which we'll talk about next. But business location to business location is business miles. Business use equals business miles. All right. So you take your percentage of your business miles to your total miles. Let's say it's 60%. You're going to take the cost of everything: fuel, oil, insurance, repairs, interest on the loan, even the cost of the vehicle. And you can take 60% or whatever your percentage is and deduct that. Some of it's going to be deducted over a few years, like the cost of the vehicle, but basically all those expenses, you take the actual expense, you deduct it. Standard mileage rate, you take the miles you drove, the number of business miles you drove, and you apply the IRS standard mileage rate. For 2023, it was 65.5 cents. 2024, I think it's like 66 or 68 cents. Thank you. Would you like a job? I'm hiring. Keep that in mind. So around 60 something cents per mile. That's it. That's the deduction. You drove 1,000 miles, you get a 600 whatever dollar deduction. So just looking at it, which one do you think would give you the bigger deduction? Who thinks it would be the actual expenses? You have a note. Depends on how much you drive. So it's kind of split. Good answers. It depends is usually my go-to answer. Actual expense method usually gives you the sexier deduction, meaning you go buy the $85,000 vehicle on December 31st, you drive it one time for business. Technically, it was 100% business use that year. So you write off the whole damn thing all year, whatever. The next year you do something similar, maybe. It looks like a really good deduction. But honestly, over time, the standard mileage rate might actually give you the bigger deduction over the longer period of time. So I'm going to talk about that. I'm going to talk about being able to even use the actual expense method. To use the actual expense method first, and this is the part that most people can't get over this hurdle, the vehicle has to be used more than 50% in business. That's a hard IRS rule. That's not my suggestion. You have to use the vehicle more than 50% in business to use the actual expense method. Let's say you do. Fine. If you use the vehicle 50% in business that first year when you bought it on December 31st, you deducted all this big depreciation expense for the cost of the vehicle, and then the next year, your business use falls to 49%. The IRS says you cannot use the actual expense method anymore. You can't use it now. You can't use it again. And that big deduction you got for the cost of the vehicle, pay that back immediately. It's called depreciation recapture. It's gross, but it's a thing. Even if you chose not to deduct the cost of the vehicle because you didn't want to fall into that trap, the rule technically says you have to include in income the depreciation that you did take or could have taken, whether you got the deduction or not. So big trap on the actual expense method. But let's say you consistently use the vehicle more than 50% in business every single year. You qualify, it's legitimate, fine. Let's say it's 70, 80% every single year. Year one, you buy the vehicle, you write off most of the cost. The rest of it gets written off in year 2 and 3 and 4 and a little bit left in year 5. You keep driving the vehicle in year 6 and 7 and 8, all you're deducting is the pro rata cost of gas, insurance, repairs, whatever. You've already deducted the cost of the vehicle. With the standard mileage rate, I don't care if you drive the vehicle for 25 years. You get 65.5 cents or whatever the rate is that year per mile every year that you drive it. So depending on how the numbers work out, you could actually deduct more than the cost of the vehicle and all the fuel and everything else with the standard mileage rate just by driving it for a longer period of time. So again, it's not the sexy deduction. It's not the call my CPA and buy this F-250 before the end of the year and spend $85,000, but it's actually sometimes the better deduction. So I usually suggest standard mileage rate. You also don't have to keep track of your receipts for gas and oil and all that stuff if you're using standard mileage rate. You just have to keep mileage records. Mile IQ is a good app for that. A lot of my clients use that. If you're already paying for QuickBooks though, you can download the QuickBooks app and it has a mileage tracker in it. It'll track your miles automatically. And then when you go in to review it, it'll be like on February 8th, you drove to Lafayette, Acadiana Center for the Arts. Was that business or personal? That was business. I went to a thing. And so you can like swipe it left or right, and then it adds up all your business and personal miles. So Mile IQ, QuickBooks, also have like photographers that at the end of the year, they'll just look back at their Google Calendar and they'll see all their bookings that they had, and they'll pull up Google Maps and they'll pull up a spreadsheet and they just start jotting through it. Now, one thing about that, if you try to deduct mileage and you're going back and making extemporaneous records after the fact, IRS requirements say that the records have to be done timely. They don't define what that is. But if there's any question about whether or not it was a business trip and you say, I don't remember, that was at the beginning of the year and I did my mileage at the end of the year, they're going to say, oh, well, then you can't prove it was business because you waited too long. So ideally, you're doing this on a monthly or quarterly basis. Yes, it is. Yeah. Yeah. All right, next question. Home office deductions. Two rules, two tests you have to meet to be able to deduct a home office for a space to be considered a home office. First, it has to be used exclusively for business. It cannot be in-home studio. Yes, yes. Technically, the form is business use of home. So office, studio, great question. Anything that you do business in the home, you have to only do business in that home. So I'm sorry, in that space of your home. Meaning if you're trying to say, well, every night before bed, I get in bed with my laptop and I do all my bookkeeping and I track my miles and I send invoices and I do my business social media for a couple of hours. If you're trying to say that all you do in the bedroom is business, that's on you, but chances are the IRS won't believe you and that's not going to meet the exclusive use test. Next, it has to be your primary business location. Primary business location just means it has to be a space that you can reasonably expected to only be able to do that kind of work in. As an example, if you, let's say you have a studio that's outside of the home, that you rent studio space, you sell paintings, or you go there to paint, but you don't have a desk and an office that you can just sit down and do the damn paperwork. But yet at home, you have a desk and an office that you can do that. That's all your administrative work. And so you can say that that home office is the only place I do administrative work. And so it's my primary business location. Or the other way around, maybe you use WeWork or one of these co-working spaces to do the administrative work and you have the studio at home and you really don't have access to another studio. And even if you did have access to it, you chose to do it at home, then that could be your primary business location as well. So again, just like with the vehicle expenses, there's two ways that you can deduct home office deduction: actual expenses and simplified method. You're seeing a trend. Actual expense method, you take all the expenses of running your home. You take the real estate taxes, mortgage interest, utilities, internet, home repairs, roof replacement, whatever, even the cost of the home. And you can deduct that as a percentage of the home office to the total home. It's based on square footage. So business miles or business use of vehicle is miles, business use of home is square footage. So let's say that home office is 10% of the total home. You can take 10% of all those expenses and you can deduct that. Am I in your way? You don't need me in that picture. Yeah, feel free to take pictures of any of this. Like none of it's copyrighted or anything. So business use of home, 10%, take 10% of all those costs deducted on your taxes. Simplified method, you take the number of square feet, you get $5 per square foot. That's your deduction. You don't have to track any of the expenses. Doesn't matter if you even spent $5 per square foot in the home office, $5 per square foot, simplified method, capped out at $1,500 deduction or 300 square feet home office, which is substantial. The problem with the actual expense method is when you go to sell your primary residence, typically speaking, did I do something wrong? All right, I got a question back. What's your question? Mm-hmm. Mm-hmm. If you have, so I'll give an example. There was a dentist with a dentist place, you know, wherever they call it, dentist place, clinic, whatever. And in that building, there's an office and there's a desk and there's a computer and there's stuff to do administrative work and they do some stuff there. But also they do some stuff at home and they do some invoicing at home and some bookkeeping at home. Even if it's specifically for business, you didn't meet both tests. So it's got to be exclusively used for business and it has to meet the requirement that it's the only place that you can do that work in. So good question for home office. If you have two locations, like an outside of the home and an in the home, example, I work in my home. I don't have an outside office. If I bought a location and I had a physical location, even if I kept my home office would no longer be an eligible home office deduction because I have another place I could do that same work in. Now, if I'm sorry. Add it to my tab. If I met with clients, hey, no harm, no foul. If I met with clients outside of the home and I just had, like, let's say a conference room and I only use that space to meet with clients, to do consults, to do things like this, to do seminars, whatever, but I didn't have like a space that was mine, then I could maybe make the argument that no, my administrative work is at home. I don't have a place to do that at the home office, at the outside office. All right. Yes.
Isn't it not just for administrative work?
Yes, correct.
You know, you have to like photograph, paper, things, whatever you make, whether it's paint.
Yes.
It's like that space. Too.
Correct. Correct. It doesn't have to necessarily just be admin work. I use that as an example. The reason I use that as an example is because there was a court case that said if you have any location outside of the home that you can do anything, then you don't get a home office deduction. And so then I'm sorry, I'm going to like really nerd out on this. Then there was actually a law that got put in place that counteracted that said, no, we're going to count primary business location as long as you're doing some function of the business and you can only do that function at your home office, then that counts that space as a home office for that deduction. Yes, correct. That's federal law. Very good questions. So with the actual expense method, was there another question? I'm sorry. What you got?
What about if you rent an apartment and
yes,
a part of your area? Like I actually use part of my living room. There's like a little corner where I just do all the stuff, you know,
yeah,
painting. I'm not good at business, but let's pretend that I did do business. So that would be my corner, okay? So even though it's not a separate room that has like a specific square footage, like how would I deal with that?
just if you have like ceiling or floor tiles that are square feet or you have a thing, just measure that space. Yeah. It doesn't have to be a partitioned room. It doesn't have to be a separate room. Great question. It could just be a corner of a room, a half of a room. Just be careful that you're not including like the dining room table or the kitchen counter in that, you know, like if you have a desk over in this corner and you just want to count out, okay, well, it's 20 square feet, whatever, you know, then you can use that. But I'm glad you mentioned rent. I'm going to bring that up in a second. So when you go to sell your home, your personal residence, and you haven't done any home office stuff, you typically don't pay taxes on that gain. There's exclusions to that. But if you had a home office and you use that actual expense method, then just like with the vehicle falling under 50% use, the IRS says, well, wait a minute, this wasn't all personal residence. Some of this was a business asset. And now you have to pay that depreciation recapture. So you have to pay taxes from that gain on the sale of your house on part of the gain based on the size of the home office, but also on that depreciation of the entire home that you could have taken even if you didn't take it. So it's real nasty. It got so nasty that the IRS about 10 years ago came out with this simplified method that they said, okay, y'all are all doing it wrong. And so instead of us doing these audits and having all these erroneous expenses, we're just going to give you $5 per square foot. Just do that. Don't do the actual expense method anymore. What's that?
So the limit is 300 square feet.
Correct. And I think they capped it because they're basically saying, look, if you do $1,500 as a maximum, then we're going to assume that that's going to account for all the overall expenses, utilities, internet, stuff like that. But that's not going to account for like the cost of the home itself.
So if I use more than 300 square feet, I have to use the actual expense.
No, you just limit it to 300 square feet. You just take 1,500 and no more. So like if your home office is 500 square feet, and so you could have had the $2,500 deduction, you just take 1,500 instead. It's just maxed out. Most tax software is going to ask you, even like TurboTax, what's the size of your home office? If you say it's 400 square feet, 500 square feet, and you want to use a simplified method, it'll just max out that home office deduction for you. So you don't have the depreciation recaptures, you don't have taxes on the gain when you sell the house. So for 99% of my clients, I don't even let them take the actual expense method unless they like fully understand the implications, unless if they rent. If you rent, who cares about selling their house? You're not selling it. It's not yours to sell. So there's no worry about paying taxes on the gain of a house if you can't sell it. There's no worries about paying depreciation recapture when you sell a house if you don't own it to sell it. So if you're renting all day long, use actual expense method. Other side, use actual expense method, because you'll have all the rent, utilities, everything else. Do it both ways, because I've actually seen it work out better sometimes on the simplified, even with rent, if your rent's low enough, or if your rent includes utilities, or depending on the size of the space. So run it both ways and see what comes out better. But if you're renting, then you have an opportunity there to use that bigger actual expense method.
You can vacillate between the two.
Yes.
You choose to steer.
Yes. Yeah.
Designate, like when you sell your house, that you have an office designation.
There's a form you're supposed to fill out that no one does. And I think that's the reason they came up with the simplified method, is because so many people were doing it so wrong. You would just sell your house, and usually that income is excluded from, that gain is excluded from income. So then you just go file a tax return and you never say anything. And the next year you have a new house and a new address, and the IRS kind of scratch their head at it and don't do anything. And then one day you get audited and realize, oh yeah, they were supposed to do that. And then so many people were doing it wrong and not reporting it that they came up with a simplified method.
You really need to kind of look in the future.
Yeah.
Do you plan on staying in the house for a while, or is there a possibility you can move? I'm thinking of my nephew. He got into realty, and then the market went,
Uh-huh.
and now he's thinking about selling his house and moving to Baton Rouge.
Yeah.
And I don't know if he knows about that, but I know he did the actual expense. Yeah, so.
Come talk to his CPA about it. And man, I get so many comments like, well, this is our forever home. We are never moving from this home, right? Everyone laughs because like, that's not true. Like something's going to happen. Interest rates drop to 0.5%, or they climb to 20% or something, you know? Yep.
You have home value up there? All right. What if your house is paid off?
Doesn't
My
matter.
house is paid off.
That didn't change
I don't
anything.
have like mortgage interest, whatever.
You just have a little bit less deduction. So you can deduct your mortgage interest as a business expense under the home office deduction if you're taking the actual expenses. So if you don't have mortgage interest, just like if you're renting and you don't have mortgage interest, then you just don't get to deduct it.
What is home
Use
value?
that phrase now
What-
of your home. You know, that you
Oh.
always have one back.
So home value meaning what you paid for it. So if you paid, I don't care when it was, like if you bought the house 30 years ago and now you're just starting to use a home office in it and it's worth way more, it doesn't matter. Your cost in the home is $100,000 and your home office is 10% of the home. You can take 10% of that $100,000 and depreciate it or deduct it over like 30 years. It doesn't come out to a lot. So it's usually not enough it's not enough, what do they say, sugar for a dime or whatever it is. Great questions. Y'all are so enthusiastic. All right, I want you to pay a boatload of money in taxes. Like honestly, I want you to be so successful that you're just writing huge checks. Because the thing is, we're not Amazon. Amazon can get away with showing zero profit because they're Amazon. They can just dump millions of dollars into R&D credits or buy these tax credits offshore, and then they get all these loopholes. We don't get those. That's just the nature of it. So the tax code is written for social engineering. The tax code, the government wants to be able to control things. That's why businesses can deduct interest on loans, but they can't deduct dividends for investments because they want to help prop up the banking industry. That's why you can deduct on your personal taxes mortgage interest, but not rent, because they want to help prop up the real estate industry. It's all social engineering. So there's no such thing as a tax loophole or this secret the IRS doesn't want you to know. The IRS knows. They know everything you're doing. They know all the tricks. The tricks exist because they want you to use the tricks, because then you're doing exactly what they wanted you to do. So when you see these things on TikTok or online saying like, I paid no taxes because I bought an $85,000 Range Rover on December 31st and I traded in the next day, that's great, but like nothing happened. You didn't do anything, right? So don't fall for all the online hype about like what you can do with taxes. Instead, let's recognize that we want to grow our businesses. We want this to be something that gets us out of the 9 to 5 And we want this to be something that frees us from taxes. So prepare for it. So how to prepare for taxes? First, you need to track things, different ways to track things. QuickBooks is great if you need it. Not everybody needs it. I get into those conversations. I won't cover that. If your business is big enough where you're sending invoices and stuff through QuickBooks, it's good for that. If you're tracking customers and things are selling for QuickBooks, it's good. And a lot of photographers use Honeybooks for that kind of thing. So QuickBooks is sometimes overkill if all you're trying to do is track expenses. Wave, I think it's Wave, is a free app. I want to say it was actually bought by H&R Block, and it's free accounting software. It's a little bit clunky. If you like numbers and you like accounting, you could probably handle it. But if you don't, it's going to scare you a little bit, but it actually is really good for not having to pay for it. They try and make you pay through like payment processing fees and setting up that kind of stuff. And then want you to get into the whole H&R Block ecosystem, but that's free, or just use Excel. Get an Excel sheet and put date, payee, amount, description. You collected money for a photography shoot, put January 1st, Seth and Jessica Norris, $3,000 wedding photography. You paid Amazon for supplies, January 2nd, Amazon, negative $50 supplies. And just do that every time. Download the CSV file from your bank statement, meaning like you can download all your transactions from your online banking into Excel and just make a new column and start typing in what it was for. That's bookkeeping. You can do that too. There's nothing wrong with that.
Probably plug for the Google Sheets, it's free. so you
Yes.
can divide.
There you go. Good point. So if you're in like the Google Drive, Gmail ecosystem, you can use Google Sheets. Does most of the same stuff as Excel, some of it more than Excel for free.
You program your own formulas in Excel.
Yeah, in Excel, you can do formulas. You can do formulas in Google Sheets too. It's their version of spreadsheets. Yeah. So preparing for taxes, Profit First is a system. It's a book written by Mike Michalowicz. I can't spell the last name, but it's basically a cash management system. So instead of waiting until the end of the year to say, was I profitable? And you go to Seth and you say, was I profitable? And I say, good news, you were profitable. You owe $10,000 in taxes. And you look at your bank account and it's got like 14 bucks in it. And you're like, where's the profit? I thought I was profitable. There's a difference between your cash bank account profit and true accounting profit. So book Profit First, he says, why not instead, if you're going to use your bank account to do your accounting anyway, let's just use your bank account to do your business. And let's reverse engineer it to work for you. So you want to be profitable, take the first 5% of every dollar you make and put it in a separate bank account called profit. Don't spend it. Now you were profitable. If you don't spend the money, you have to be profitable. Let's do it for something else. You got to pay yourself. You should be paying yourself. You're the owner of the business. Take 50% of your pay of the business income, put it aside for your owner's pay. Don't spend that. You have to pay taxes. Take 15%. So if you don't do anything else on this, everyone write down, take 15% of your business income, put it aside for taxes. If you can't put 15% aside for taxes, put 2%. And then next month, put 3%. And next month, put 4%. You won't even notice, right? It'll be like, what is it, boiling a frog or whatever they say.
So what kind of account do you put that? What does the bank offer you that you can have an account for that?
I love Relay Bank, or ELAY. It's a new online bank where you can have as many business bank accounts as you want. So you get set up with your business. It's kind of a process. You got to send in like your business documents. But once you're set up, to make a new bank account, you click add, name, save. You have a new bank account. You do it over and over again. They let you have up to like 20 bank accounts and 60 debit cards if you wanted them for some reason. I have Relay and I've got an income account where all the money goes in. I have a profit account that gets transferred to, a tax account, an owner's pay account, a conferences account because I want to save it for a big conference I want to go to, a technology account because I want to save it for a new computer. So all that gets put aside. And with Relay, you can actually set up, you're not taking a picture of me, are you? Yes, ma'am. It's a bank. Correct. So that is my business bank. That's the only bank I use for business purposes.
Just like that's your bank for everything.
For business purposes. For personal, I use a different bank. So if I'm paying myself, I just make a transfer from Relay and you can do it as like a bill pay for free. And I just pay myself to my personal bank account, which isn't with Relay.
And how much?
It's free. It's free. No monthly fees, no minimum balance fees, no transaction fees. You can pay for like the pro version that you get like free international wires for some reason. So if you're interested in it, I do have access to a support person that can onboard you a lot more easily than you to go to a website. Get with me after and I can get you a link for that. Thank you.
If you, so you're doing flow through. So couldn't you just pay more quarterly taxes?
Yes.
Okay, and if you also have another income, couldn't you get them to increase your W-2 contribution?
Yes, yes. You mean instead of doing 15% from the business?
Yes.
Yes, you could. I don't trust myself to actually do it the right way. So every month I have 15% come out of my income into the tax account. That's where I would make my quarterly payments if I'm doing quarterly payments. Now, a year ago, I was telling people, I'm on camera, but I was telling people not to worry or do the math on quarterly payments because the penalty for not paying quarterly was less than the interest you can earn in a savings account. So I'm like, I'd rather have the money in a high interest bearing savings account earning 5% and then turn around and pay the 3% penalty to the IRS if I even owe it, instead of having to oversend the money to them and beg to get it back. They've caught on and they've raised their interest rate. And so now the math might not make as much sense, but if you didn't want to have to set up like Relay or one of those accounts, Ally Bank is usually the highest interest bearing savings account I can find. ALLY, like an ally. They don't have branches, they don't have physical locations, and so they can pour all their money back into interest rates. 4 or 5% right now, I think maybe is what you can get, and it's just a savings account. It's not even a business account, it's just a personal savings account. They might limit you to 6 transactions per month, but you shouldn't be getting the money out if you're saving it for taxes. So I actually take my money from my income account. I move it to a tax account that's in Relay, and then I really don't want to see it, so I move it out of Relay into the Ally account. So if I log on to Relay, I don't even know it exists, and I don't have online banking on my phone for Ally. I don't want to know it's there because I'll go move it, like I'll get the stupid ad about the little remarkable tablet and I want to spend the money and I don't have it in my operating expense account, but I have it in my tax account. I'll pay it back next month, I promise. I won't. So if you don't do anything else on that short, put 15% of your income aside for taxes. And you think, well, 15%, I have 20% personal tax rate and 15% self-employment tax rate. Why only 15%? Because you're putting 15% of your revenue before expenses aside for taxes. I'm not going to make you do the math on what was my net business income this month and how much did I spend and what deductions were really deductible and what weren't. Don't worry about that. Just do 15% of the big number, and it's usually going to get you pretty close to what you need of the small number. You don't have to do this alone. I've done this for a lot of people. I do a lot of different things: consulting, coaching, QuickBooks setup, training, everything you see there. The QR code's my website. I'm on Facebook, Instagram. Speaking of Facebook and Instagram, can I bother y'all to take a selfie with me? I hired a social media manager this year, and she has been hounding me to get more pictures, and she specifically said I'm supposed to get a selfie with y'all. You don't mind? Thanks. All right, everybody wait. Wrong way. Everybody wave. Great. She's going to make that look awesome. It's amazing what she can do. She makes it look like I know what I'm doing. I've told her before, I was like, man, I would hire me based on these videos that you're doing. Is that it? That's the end of it. So that was a lot. Again, don't fall for the hype of what you see online with all these giant deductions. You can't just set up an LLC and buy your house in the LLC from your personal. No, it doesn't work. Like, none of that's true. It's just, yes.
Salacious information, but like for retirement. So like I find like with creators, when like there's not a big focus on, it's just make enough to pay rent or pay your utilities. But for like retirement, I've heard like put in a Roth as an LLC, pay yourself from the Roth as a salary.
Huh? I haven't heard of that.
$6,000 contribution or 7,000 now. Like you can put hard assets in a Roth and borrow against it, and that can be your, then you have that instrument as a retirement.
I don't suggest it just because it's confusing.
Yeah.
That's really it. Just because the more complicated you make it, the more opportunities you have to fall into a trap. You want to say for
Being audited or just not.
being audited, not meeting the requirements. They change the rules on you and you don't even know it. Used to Social Security wasn't taxable. Now it is.
It comes out of your paycheck your whole life.
And so right now, distributions For retirement, so that goes back to the LLC versus S corp question. With an LLC, you have an opportunity to set up an SEP, Simplified Employee Pension. What's great about those is the big hurdle with an SEP is that you have to offer the same percentage contribution to all your employees. Great for solopreneurs who don't have employees, because then you don't have to worry about it. So with an SEP, you actually have until the extended due date of your tax return, assuming you extended your tax return, which can be up to October 15th, to make a contribution that counts for the previous year. You can even set up the SEP if it didn't even exist up until that due date for the previous year. You can contribute to it. It changes every year. Last time I looked, it was $65,000 or 25% of your income, whichever one's less.
Okay, so the SEP, let's say
Mhm.
this year, you know, you contribute to it, next year you can't.
Don't,
It's
it's totally discretionary. It's not based on a formula you set up. You just decide that year. So normally what happens is I have clients who have an SEP, excuse me. They'll say, hey, before you file, let me know what I can contribute to the SEP based on what the tax return looks like. So I'll do the tax return. I say, you can contribute $4,000 is going to save you $1,000. And so they'll, because it's a tax deduction. It's deductible. Those contributions are deductible.
So if you
Yes.
have a wrong, yes, also.
Yes, now there are limits on how much you can contribute to all retirement accounts combined, so you have to watch out for that. So that's a way to contribute to retirement for if you're an LLC. If you're an S corp, what I like to do is towards the end of the year, since you have to have payroll anyway, and you have to pay yourself a salary, well, let's get to the end of the year and decide how much money you want to put in retirement. We'll give you a bonus, and you'll contribute that bonus to your 401k that you set up. But that has to be done before the end of the year, so it's not as much flexibility there.
I
Yes,
have a
ma'am.
question about grants.
Oh, no.
So, say you're an individual artist who has one revenue stream, whether it's a, W-2 or a LLC, but then you're getting a grant, which is taxable income. How does that affect it, and how do you operate these things together? And then also same question for for nonprofit organizations,
Mhm.
arts and cultural organizations who are also getting grants as part of their operating. Like how does that all?
For tax purposes?
Yeah.
Nonprofit's easy, it's not taxable. So you're a tax exempt entity. So if you're a nonprofit, you have to request, back up a little bit. A nonprofit is just a business that has gotten approval from the IRS to not be taxed. So a nonprofit is a business that says, IRS, I'm doing one of these many things that you've listed as tax exempt activities. And so you say, can I be tax exempt? And they say, yeah, you can be tax exempt. So as long as your nonprofit is doing things within that, then you're tax exempt. If you start moving outside of those activities, there's a term for it. It's basically non-qualified activities that you could be taxed on. For grants, if you're not a nonprofit, you're an individual or a business and you got a grant, if it's taxable income, I treat it the same exact way as you would treat any other income as if you made it from a person. Put it in your income account, put 15% aside for taxes, treat it the same way. Now, if you have income, this is something I love to do. If you're an artist and you have seasonal income, right? Or if you're a CPA and you have seasonal income, how do you get that money to last the rest of the year? If you get a grant at the beginning of the year and it's for your commission project and it's supposed to last months, how do you not spend it? Take it, you put it in a separate bank account, because I have all these bank accounts called a drip account. And I calculate how much I should need every month. And every month, that's how much I take out of that account and put it into the machine that is my bank account system. So if I know I need $5,000 a month and during tax season, I'm generating more than that, the excess goes in the drip account. After tax season, I'm like, oop, no more money. I take however much I need from the drip account to my main operating account to make up that difference until it runs out. Hopefully it doesn't run out. You've done the math the right way. But that's a really great way to levelize your seasonal income if you're a seasonal worker. I make way different decisions depending on the balance in my bank account. Like if I'm looking at my bank account and it's fat and pretty, I'm buying the expensive office chair, I'm upgrading my computer, I'm going on the business trip. If there's no money in it, which is like the rest of the year, then it's panic mode. It's call the banks to get a line of credit. It's sell one of the kids. It's figure out how little we can eat for the month. It's start raising chickens, right? Call clients and see if they need some tax planning services real quick. So like, I don't want to operate my business like that. That's not good business operations. You shouldn't be making decisions based on the balance in your bank account. So make the balance in your bank account a standard amount each month, trick yourself into making good, logical business decisions.
30%. Is that what you said?
Yes, absolutely. Yes, ma'am. Yeah, I'm like, look,
Did you apologize to?
no, I just know I'm terrible. I'm garbage. Like left to my own devices, I'm not going to do things the right way. I don't think any of us do. This isn't natural. None of this is natural. We're supposed to just go out, kill something, eat it, and go out and do it again, and then repeat and repeat. And so all this is very unnatural. If you follow your natural tendencies without a system in place, for me, it's not going to be good. So that's why I like the profit first system. It gives me that system to be able to trick myself into acting like a good business owner. Anything else? Any questions online? I don't even know if anybody joined online. I have no idea how long this is. How long is it supposed to be?
We have until 7.
Till 7? All right.
But-
I have no more slides, so we can visit and talk and ask the questions.
Very specialized, but what about inventory of painting for an artist?
Okay.
How do you determine the value of the inventory?
That's a good question.
Of in progress work?
They're not that cheap of paint, it lasts you 3 years or something.
It depends on your purpose for the value. If you're doing it, I've heard of people trying to make a painting and use it as collateral for a loan. In those cases, you have to like have an appraisal and things like that. You mean like for your accounting purposes?
Yeah,
Yeah.
if I need to do an inventory,
Mhm.
of like the paintings that I did for the year, the way I have been doing it is to put all the materials together that I used to make one painting
Mhm.
and give an estimate and then add all that up for the whole year to do an inventory.
Mhm.
The value, the material value of what I've made.
Is that for your property taxes that you're doing that for, or is it just for your own purposes?
No,
It's an expense, cost of goods.
Well, so for tax
yeah,
purposes,
Yeah, it's cost.
for tax purposes, you expense it as you pay for it. So there's a revenue ruling that came out, I lied to you, a few years ago that says any business making, gosh, less than like $10 million, it's some ridiculous number. You can use this de minimis safe harbor where you basically just say, all this inventory that I'm paying for, I'm just going to expense it as I pay for it. I'm not going to put it into inventory and then wait until I sell it and assign it to a sell and do cost of goods sold and all that. You pay for it, you sell it. My wife's an author and she does direct sales for her books. So she'll buy pallets of books and then they sit and then she sells them. We deduct the cost of those books as she purchases them, not as she sells them. I have another client that has a gift shop. She buys clothes, gifts, souvenirs, whatever. She monograms it, so it goes into in processing. I don't care if it's been sold or not. I don't care if it's in progress or not. She spent the money, she gets a tax deduction.
You only need to do that if you were trying on personal property tax.
For personal property taxes is a little bit different. For personal property taxes, you're going to get that Lat 4, Lat 5, something from the assessor. So, yeah, okay. Yeah, for that, you might want to keep track of like the finished goods inventory or your supplies. But yeah, for your own purposes, for tax purposes, deduct it as you spend it. For your own purposes, I personally would still show it as an expense as you spend the money, unless if there's a reason why you want to know the value of the inventory you have on hand. But from like a cash management standpoint, I'm only caring about how much cash I'm spending each month. Because I could go and spend all this money and it not show up as an expense because it's sitting in inventory. And if I look at my profit and loss statement, I have this fat net income, but I also have this big inventory amount that I haven't sold yet.
So that's potential income, really.
It's potential income, yeah, which is again, one of those stupid accounting tricks that make it seem like you could be profitable, but maybe you're not profitable because you're spending too much money on inventory. I remember in business school, they said inventory is like the tide that comes in and it covers the problems and all the rocks underneath. So too much inventory can actually hide some problems. So for small businesses, I recommend, and again, unless if there's a reason why you want to know, like Jessica wants to know how much inventory she has on hand because she has to reorder books whenever she gets low. So she tracks that on a spreadsheet separate from her accounting system, but that's just to be able to reorder it. For accounting purposes, it's an expense when she buys it.
So use our, a really good app to catalog your work and keep track
Oh,
of it.
what's that called?
Artwork.
Hard Work Archive.
It's an archive system for your art.
Love that.
It's really amazing. It keeps track of all your contacts, your sales, your value of your work, all your, everything, you know, and that's, these are the sold ones, these are available.
I love
and
that.
It sort of tracks your work. So,
I am, just so that you'll know, I am putting on a workshop about archiving your artwork, and that'll
know
be
that?
next
Yeah.
month. Yeah.
archive, do you know that?
I don't, personally, I don't, but Higit Bakari from UL will be presenting a workshop on
Here?
archiving here. Yeah, it'll be next month.
Okay.
Mhm.
I've been making art for over 25 years, and at a certain point, I was like, I need to figure out, it tells me where what collector has it, where it's located.
Oh, yeah.
What gallery has it, you know, where it exists in
Mhm.
time. You know, so if the piece moves back to my studio, I took the button into my studio, not at the gallery.
Yeah.
Kind of tracks the pieces.
Because that's different from like, I'm sorry, I keep picking on my wife, but different from Jessica selling books. She doesn't care where that particular book is, but like, that's your art. And there's only one version of that particular piece that you did. So it means something. That's interesting.
It's really nice, like you're saying, it goes way back.
Yes, you can.
Yeah.
I backtrack. One day I said, I'm gonna do this, and I just backtrack and try to just archive everything so I can lose it. And of course, there are pieces that I know, I'm not sure where they are from a
Yeah.
long time ago.
Yeah.
Or that was in the system, but it's gone.
Yeah,
So.
that's still interesting. If nothing else, you have a portfolio of everything you've done.
You can do invoices with it. You
Okay.
can create personal private galleries to show
Mhm.
clients or to show consultants, like, these are the pieces that are red. Here's a little private gallery viewing of the red pieces. Or whatever.
Yeah.
Silly stuff.
No, that's cool. I like that. I love this. I love any kind of tool that makes things easier.
Like say you're just starting out, like for us, like we haven't made much. Like what do you have to file, like what's?
How much money you have to make before you need to file $1? $1. The way. No, you'll get a 1099 once you make more than $600, but the IRS doesn't care about 1099s. The IRS rule is the way the tax code is written, like page 1, in the beginning, all income is taxable income unless specifically excluded. And so then they go through all their exclusions. So the tax code is one giant exclusion. But they don't care if you got a 1099 or not. They don't care if you made $599 and never got that 1099 from Venmo because they marked it as friends and family. They don't care. If you made money for a service, it's taxable income. You can deduct your expenses against it, but yeah. So there is no threshold.
Just start later. There's only months where you don't have to work on it first year.
I don't believe so. If there is, I haven't heard of that. But I will look into it.
First line, one, previous. One. One month, I had to build it.
Yes, okay. Correct. So let's say you start your business in December, you haven't really done anything yet. You haven't earned any money yet. Maybe you have some expenses. Do you have to file a tax return with your business on it? No. Taxes are all cash basis typically. So if you haven't received any money, you haven't received any taxable income, but you might want to set up a business tax return just to be able to deduct some of those startup costs. Yeah. No, in my opinion, that would have been because you didn't receive anything yet, not because of the number of months.
So. Earlier, so for our clothing business, we could write off that like shirt that we bought.
Yeah. Absolutely. Yeah, that's supplies. Yeah. What category? So on the tax return, there's I'm picturing it. There's gross income and then cost of goods sold. And there's like a separate sheet for where you could calculate cost of goods sold if you're doing inventory, like your beginning inventory and purchase and all that. All those things I just put in the purchases under cost of goods sold.
You recommend like setting up different business, so like if you have like a consultant range of your company or your brand, right? And then you have the actual where you produce art, so you have sellable products. Is that all just part of you, who you are, one person, or do you recommend siloing those factions of the business.
For tax purposes, it doesn't make a difference. If you don't have a good business reason, one good business reason might be if you're trying to make the best use of your LLC. Let's say you're doing consulting work as an artist, but you also produce art and it's high value art. And you do consulting work and somebody says, well, you screwed this up, we're suing you. If it's all into one big business, all the business assets are susceptible to that lawsuit. So that might be one reason to separate them into separate things. If you own real estate, you might want to do separate businesses, one for the real estate, one for the business. Tax purposes, it's all going to get lumped together anyway. There could be situations where if you have enough different business entities or business activities, that it makes sense to have one overarching entity that holds the other entities. And you can play with S corps at the top level and like do some fun tax planning there. But just in and of itself, usually there's no tax reason for that.
Should be a liability.
Yes, I would say for a liability reason. It is going to make things a little bit more difficult if you're setting up like business bank accounts and you want to have one set up in the name of this business and one set up in the name of this business. I've seen situations where invoicing software will send the payments to the bank account, but the name on the bank account has to match the name of the business that invoiced. And so then if you have these separate businesses set up, it could become weird to get those going to the right place, you know, but you could also do DBAs if you're just trying to separate the name and the brand. You could have whatever enterprises DBA, blah, blah, blah consulting, and whatever enterprises DBA. That's just a quick Secretary of State filing. Speaking of Secretary of State, this isn't tax related, but it pisses me off, so I'll talk about it. Have y'all heard of the BOI, beneficial ownership reporting? CTA, okay, yeah, that's usually the answer I get. Yes, yeah. So if you're on my email list, you got an informational email about this, but beneficial ownership information reporting, BOI, it comes from FinCEN, which is the Financial Crimes Enforcement Network, which is a department of the Department of Treasury. So very convoluted. It was passed in the Corporate Transparency Act as part of the defense spending bill. This is as convoluted as it gets, like it makes no sense. It's meant to fight money laundering and all that stuff. So you have these business entities that own business entities, and it gets into like this Russian doll thing where it's just business, and looking at it, you have no idea who the individuals are who actually are earning this money or transferring these funds around. So the government wants to know who are the human beings, the souls that are controlling this business. So starting this year, brand new, this started in January 1st, every single LLC with less than 20 employees, so for some reason the big businesses are excluded, the small businesses have to do this, has to file a beneficial ownership information report with FinCEN. The beneficial ownership information report tells FinCEN, this is the name of the business. It's Norris CPA. This is the EIN, the tax identification number. This is the address. And these are the owners. And for each one of those owners, this is the owner's name, address, date of birth, social security number, and one form of identification. And you upload all that to a government portal because it's totally secure, because they're trying to fight money laundering. And so all these Russian oligarchs said, you found us, you got us. We're going to file this report, and now we can't launder all this money across the, like, it's not going to solve any purpose. But the thing is, they're charging penalties of $500 per day for non-compliance, up to $10,000 and 2 years in prison if you don't comply with it. For any business LLC that was in existence before January 1st of this year, you have until the end of the year to file your first report. For any business entity that gets formed during the year, business entity not being a sole proprietor, it'd be like an LLC, an S Corp, anything you have to go to the Secretary of State to file for. If you file something during this year, you have 90 days to file your first report. And I think you have 30 or 60 days to file changes. So what kind of changes would you have? You move, change your address, file a new report. You get married and your last name changes, file a new report. You have partners in a partnership and any one of those partners moves or changes their address or changes their last name, you have to file a new report for each one of those partners for every business entity that they're a part of. It's a mess, and there's lots of legislation trying to stop it, but none of it has stopped it yet. So as of right now, it's current law. CPA's liability insurance has said, we're not paying any claims for these. Y'all don't do these. So CPAs are like, we can't do them. They're even telling CPAs, be careful about advising about doing these, because then somebody could take our words and say, well, he said I didn't have to do it, so I didn't do it, and then they could sue us. Or they're saying, be careful of not advising on it, because then you could say, I never told you about it. So it's a big, big mess, and everyone's kind of aggravated and scared of it, but just know that it's out there. If you haven't heard anything about it before the end of the year, you probably have to file a report, unless if you don't have an LLC. Just know it exists.
So it does not apply to a silver card.
It does not, unless if you have done your registration as an LLC.
Okay.
Correct.
And it's not something intended that you do every year with your tax return?
Correct. It's totally separate from the IRS. That was another thing. So doing a tax return is technically practice of law, but the IRS has this provisional thing where they say tax preparers can practice law under the realm of doing taxes, because it's just applying tax law. This doesn't fall in the IRS, but it's still technically applying law. So there's some states where they're saying only attorneys can do this because it's technically law. And if you're not an attorney and you do it, then it's unlicensed practice of law, which is illegal in some states. So there's lots of confusion. Some attorneys are saying they won't do it either. And so everyone's like, well, who's doing this? Then if CPAs aren't doing it and attorneys aren't doing it, then I guess you're on your own, but I don't know. Yeah, yes, ma'am. I went through the process. It's not terrible. It isn't. There's a website, there's a portal, it's a few clicks, fill in the information. It's all information you have. My biggest concern is the security of it. I don't think I had to set up an online account or a password or anything. I think I just had to put in my business information, and they're like, send us a picture of your driver's license. And I was like, I'll finish this later.
Sounds like
Beneficial ownership information reporting with FinCEN, F-I-N.
So BOI, if you search BOI, you'll find something about that. Information.
But probably be careful not to get caught up in these scams of people who say they'll do it for you. And
Yeah, be careful of all the scams out there. Don't go, it's gotta be done. Always not, if you're setting up like EIN, the IRS, make sure it's not, if you do it, does that, and ask all our information.
that's what I was saying.
Still,
I'm from the government and I'm here
I
to run for office.
I had a client who told me before, like, said, this just doesn't make sense, and I was like, it doesn't have to. Like, it doesn't matter if you're in there and not just the rules, so it probably is what it is.
When we adopted our son, we got fingerprinted by like 5 different agencies, but like we have our fingerprints. But the agencies don't talk to each other.
You, our son, he doesn't look like your dad's a we adopted you from China, and like you said, because of these agencies, and every time you turn around, you get fingerprints and driver's license, social security cards, and birth certificate, and then they told you the privilege of doing it, and they're like, okay, pay taxes this whole time. Or this department to exist, and just use along with it, so. I'm here to help reduce my taxes. I'll be actually for it.
Well, before we, I guess, conclude, because it feels like it's coming to that time, thank you so much, Seth, for coming along today. I just also wanted to quickly point out that we are in a current grant cycle right now. So if anybody is an individual artist and wants to learn more about it, I have the guidelines here for you to look over. But otherwise, our next Creative Acadiana workshop will be the Legacy Planning Archiving Workshop with Hagit Bakari. And we do have a whole bunch of other things coming up later this year, so keep in touch. I will email everybody a copy of this video, so you'll have it for your files. You can look back at it again for all the great information that Seth had, and there's a lot of it, and you spoke very fast, and it was, it was fantastic. But yeah, if you'll want to help me thank Seth for his time here today, that's great. Thank you so much.
Yeah, any questions about anything, if you want to get in touch, continue after, just give me the email address, so I'll give you mine. And we can get in touch.
that was.
Did that get on camera? I didn't do it, like she said, it's fine.
Social media.